All right, so here is a little bit more about how a market actually works and how prices are determined. Maybe you don't know how prices are determined, and this is how it happens. There is the bid, and there's the ask. There are the people who are saying, I'm raising their hand saying, I'm willing to buy it at this price. That's on the bid side, and there's people over here trying to sell it, and they're saying, oh, I'm asking this price. So there's the bid and the ask, and where they meet is the price that is quoted on the market. So, for example, right here, say the price is currently trading. Maybe there's 10 contracts available. This someone's saying, I'm willing to buy 10 contracts of gold at 11.75, and then someone's over here saying, well, I like to sell 5 of them at this price, and maybe up here there's 7, or maybe up here there's 18, etc., etc. Right? And where these prices meet is the price that is quoted and you see on the charts or you see on the ticker symbols. Say this is 17, 20, and maybe 30, right? Of course, these are just I'm putting the amount of contracts that that maybe somebody's willing to buy, and over here somebody's asking to sell. And in gold on the futures market, one contract equals 100 ounces. So if the price is at 11.75 per ounce, well, that's $117,000. And silver, one contract is 5,000 ounces. They have mini contracts as well, but the full-size contracts are the ones that really move the price. So as I mentioned earlier, anybody with large enough account can come in and create supply. And what can happen, and what has happened at very opportune times, like in the wee hours of Tokyo trading or in the middle of the night in US trading time, what will happen is a large amount of contracts will hit the bid stack. So this is called the bid stack. This is the place where people are raising their hand saying, I'm willing to buy it for this price. They've already put their order in saying, I'm willing to buy it at this price. And if somebody were to dump a number of contracts, then it would just go through all of these right here. So if, say, somebody said, if someone said, okay, well, if a seller is on the market and wants to sell it, they can either put their price over here and say, I want this particular price, and it would go in this column, or they could just immediately take what someone's willing to buy it for. So there's two ways to work it if you're a seller. Now, normally, if you're a seller, you want to get the highest price possible for your item. So you would either put yours over here and say, I want it for a higher price, or put it right very close to the most recent price, and hopefully you get somebody who says, okay, well, I'll take your asking price, and then get it. But if somebody doesn't care about the price, which is what we've seen with a lot of these gold and silver sales recently, where they dump just billions of dollars worth on the market, then they just blow through all of these offers. So say, I mean, in this you've got 10, 17, 20, and 30, and 35 contracts written here, right, at this price, 11.75 per ounce, 10 contracts, 11.70 per ounce, 17 contracts. If somebody comes in with 10, 17, 20, 30, 35, then immediately the price, and they took these bid prices and they just immediately sold, then the price would immediately move down to 11.55, and that would be that. The new price for the gold would be at 11.55. And anybody that's sold at a higher price and then can buy it back at a lower price is looking at a potential profit. I mentioned this in the previous video about synthetic supply and how it can also be very, very profitable. If you were to sell at 11.75, then in order to make a profit, you would have to buy it back at a lower price at, say, 11.55. And let me just give you an example of just a simple $20 move from 11.75 to 11.55 and what that might look like. So each contract represents 100 ounces of gold. So 11.75 you sell it,
and you can potentially buy it back at 11.55, you're looking at a $20 equity, build a positive equity value in the contract times 100 shares. So that could quickly turn into a $2,000 profit. And of course, they don't just dump one contract on the market. That wouldn't move it. Let me give you an example of what was done recently during Japanese trading during their lunch break. You can see here just massive. The volume is down here in the bottom right hand, bottom part of the screen here. I think it was 13,000 contracts were dumped. And then over here is silver. And the gold dump had a notional value of over $1 billion. So here's a shot of my account and shows the active bid and the ask columns over here. There's the bid on this side and the ask, and you see that presently there's 55 contracts waiting on the bid side. And I can't see any deeper than this, but the banks, the large commercial banks, are able to see the full position of their clients, which is another tool that they use, and I think goes against their fiduciary duty, putting their own profit above that of their clients. Anyway, you can see here on the right hand side the histogram. It shows how many contracts were trading at these different levels and where the asks and the bids sit. And what we also often see is what's called spoofing. You'll see large amounts coming on the ask side right before you get a blowout of the bid stack. You'll see like maybe 100 contracts pop up for sale somewhere around here, and this is some people believe that is telegraphing to the market what some of these large entities are going to do, so that they will also set their trading algorithms, their high frequency trading programs, to join in on the dump fest. Anyway, wanted to show you what the bid and the ask actually looks like inside of an account. And of course, this is just in December. This is the promise to deliver one contract of gold in December, but there's other contracts that are also traded.
Anyway, the reason why I bring this up is because this is what happens and can happen in seconds or milliseconds. You can have a massive amount of contracts, a massive amount of paper synthetic supply hit the market, and when this happens, it's usually at opportune times where people are taking the most illiquid times of trading and just dumping huge amounts as if they don't care about the price. And I run one of the lowest cost silver gold dealerships in Japan, and we often sell at auctions as well. And you can bet I'm not going to dump a bunch of my coins and gold and silver on the market, because if I just dump it at the exact same time, I'm giving there's too much supply and the demand's going to be less, the price is going to be low. It's very simple. Anyway, what happens here is the physical synthetic supply comes to the market, but there's a delay. There's a delayed effect to the physical. The physical actually leaves the shelves, leaves the warehouses of the exchanges, goes to the mints, gets processed into coins, and then goes in bar form or coin form to the investors and industrial users around the world. But so the paper market moves very, very quickly, but the physical is going out, being used in the world, and it has a delayed effect on the paper price, the market price. So at this point, because the amount of paper synthetic supply that is traded on the world exchanges, the paper synthetic price dictates the physical price. But like I've said before, we've got a situation where they trade admittedly about 100 to 1 synthetic contracts to physical on hand. So there's a lot more paper promises of gold and silver around than the actual metal, which is a musical chairs game that's going on. And at some point, that's going to have a hiccup. It's going to blow up, and that crisis is going to be an opportunity for people who were able to see what was going on beforehand and position themselves. So hopefully this was helpful in understanding how the paper market, the synthetic market works, and understanding why sometimes you can have an absolute blowout in the price. And anybody who has bought it and then and hoping for it to rise, but then immediately sees one of these blowouts, well, if they're leveraged and they're not trying to take delivery of the metal, then they're facing an equity loss in their account, and they usually get scared and want to get rid of it quickly as well.